Stop everything, because what I'm about to show you is not in the news headlines, and it should terrify every investor watching this. Right now, the United States is firing missiles that cost $4 million each to shoot down drones that cost $20,000. That is not a typo. That is not a rounding error. That is the math of a war America cannot win on a balance sheet. And the bond market is already telling you exactly that. As the US and Israel prosecute Operation Epic Fury against Iran, the Strait of Hormuz, the narrow waterway that carries 1/5 of the world's oil supply, has effectively been shut down. Tanker transits collapsed from 24 ships per day down to 4. Brent crude surged past $100 a barrel for the first time since the Ukraine shock of 2022, and Goldman Sachs has already warned that US inflation could snap back above 3% if this war drags on. But here is what they are not telling you on CNBC. This is not just a Middle East energy story. This is a bond market story, a dollar story, a story about an empire stretching its resources to a breaking point, while China quietly positions itself to become the world's indispensable refiner. And I am telling you right now, the financial toll of this Iran conflict could reshape global capital flows for the next decade. Let's get into it. Let's start with the war's most humiliating number. Iran's Shahed 136 drone costs roughly $20,000 to build. A Patriot PAC-3 missile interceptor, the weapon the US and its Gulf allies are firing to take it down, costs approximately $3.7 million. That is a cost exchange ratio of nearly 185 to 1. Think about what that means over time. For every $1 Iran spends launching a drone, America spends roughly $185 shooting it down. Analysts at the Stimson Center have calculated that for every dollar Iran spends on a Shahed, it costs UAE partners somewhere between $20 and $28 to intercept it, and it gets worse. The US is producing only around 600 Patriot interceptors per year, and it has already burned through approximately 14% of its entire THAAD stockpile. The Pentagon's own estimates suggest it would take between 3 and 8 years to replenish those THAAD interceptors at current production rates. Less than 2 days into the conflict, US media was already reporting on interceptor shortages. Iran, on the other hand, is believed to hold upward of 70,000 drones in reserve. At the current rate of fire, roughly 2,000 launched in the first week, Tehran could sustain this campaign for months. Iran doesn't need to defeat the US military. Iran just needs to keep firing until the balance sheet collapses. That is the strategy. It has always been the strategy. Now, some will say the US is adapting. President Trump met with defense contractors Lockheed Martin and Raytheon and claimed they agreed to quadruple production. But here is the brutal reality. Even in the most optimistic scenario, ramping up production of high-end interceptors takes up to 2 years. The war is happening now. The US has also deployed Lucas, the low-cost, unmanned combat attack system, reverse-engineered from Iran's own Shahed design and fast-tracked through the Pentagon's acquisition pipeline. It is a step in the right direction, but the US is producing a fraction of what Ukraine produces in daily interceptor drone output. The gap is staggering. Meanwhile, retired Admiral Sandy Winnefeld, former vice chairman of the Joint Chiefs, has publicly warned that the US could face serious shortages of critical missile defense systems if this conflict continues at its current pace. General Dan Kane had already privately warned President Trump about potential interceptor shortages before the initial strikes that triggered this escalation. This is the escalation escalator. Every Iranian drone launched pulls a multi-million-dollar interceptor out of America's arsenal, and the elevator only goes up. Now let's talk about what this war is doing to the financial system, because this is where the real damage is accumulating, and most retail investors have no idea. The 10-year US Treasury yield has climbed past 4%, reversing a downward trend that markets had been counting on for the better part of a year. Mortgage rates have followed, jumping back above 6%. And here is the critical thing. The Federal Reserve had been expected to cut rates in 2026 to stimulate the economy. That plan is now in serious jeopardy. Here is what drives that. Goldman Sachs economists have told clients that if the Iran war drags on and oil prices remain elevated, US inflation could snap back to 3% this year, up from the 2.4% recorded in January. Goldman had previously predicted inflation would ease toward 2% by year end. When inflation sits at 3%, the Fed cannot cut. When the Fed cannot cut, the bond market bleeds. When the bond market bleeds, the cost of servicing America's $36 trillion national debt goes up. Every single day the Strait of Hormuz stays closed, that pressure intensifies. The IMF's own analysis puts it plainly. Every 10% rise in oil prices pushes global inflation up by approximately 40 basis points and reduces global economic growth by up to 15 basis points. Brent crude surged roughly 50% from the start of this year to a peak of over $100 per barrel. Run that math. The inflationary pressure is not theoretical, it is already in the pipeline. And the knock-on effects compound fast. Higher jet fuel means more expensive airline tickets. Higher transportation costs mean higher grocery prices. Gas prices in the US surged 34 cents per gallon in a single week, the highest of either Trump's presidential term. Every sustained $10 increase in oil prices costs the average American household an additional $450 per year. For the tens of millions already struggling with affordability, that is not an abstraction. That is a real hit to real spending. Trump entered 2026 with economic tailwinds, falling mortgage rates, easing inflation, and cheap energy. The Iran war threatens to reverse all three simultaneously. That is the financial toll nobody is putting on the front page. And here is the deeper trap. If the Fed raises rates or even pauses cuts to fight oil-driven inflation, it suffocates an economy already straining under the weight of tariff disruptions and record debt. If it ignores the inflation and keeps cutting, it risks a credibility collapse in the bond market. There is no clean exit. This is the stagflation trap, and it is being set right now. Let's talk about the Strait of Hormuz, because the full picture is far more dangerous than oil prices alone. On the day the conflict escalated, tanker transits through the strait collapsed from 24 vessels per day to just 4, and 3 of those 4 were Iranian-flagged. The IRGC declared the strait closed. At least 5 tankers were damaged. 2 crew members were killed. 150 ships were left stranded in the surrounding waters. Trump announced the US Navy would escort tankers through the strait. Markets initially rallied on the news. Then the White House confirmed no armed escort had actually taken place. Prices dropped, then surged again. This is what desperate signaling looks like. The gap between the promise and the reality is the entire story. Escorting a single tanker does not change the supply equation when over 100 vessels typically transit the strait on an average day. That is not a strategy, that is theater. Now here is the piece that most Western analysts are not discussing. The Hormuz closure is not just about crude oil. It is about the entire downstream supply chain. Roughly 84% of the Middle East's polyethylene, the basic plastic in packaging, bottles, and pipes, moves through the strait, and critically, a substantial share of the world's urea and nitrogen-based fertilizers move through it too, produced by Gulf powerhouses like Qatar and Saudi Arabia. Qatar has already halted its massive LNG output. Fertilizer supply chains serving Asia and South America are now under pressure. Saudi Arabia has paused operations at certain facilities after drone attacks on a refinery. The UAE has begun lowering offshore production as storage tanks fill up with barrels that have nowhere to go. Iraq has cut output sharply. Kuwait announced reductions of 100,000 barrels per day. The Gulf's major producing nations are collectively choking off supply, not because they want to, but because the war has left them no market to sell into. Now, here is the pivot that changes everything. While Middle Eastern refiners halt operations, and US refineries are already running near 95% capacity with no room to absorb more crude, China is sitting on massive, underutilized refining infrastructure, running at roughly 70% capacity. Think about what that means for the emerging energy order. As Western-aligned supply chains fracture, China is positioned to become the world's primary refined fuel supplier, not just for its own consumption, but for the entire BRICS periphery: Brazil, India, Turkey. These are nations already heavily dependent on Middle Eastern nitrogen fertilizers. That dependency is now at risk, and the country with both the stockpiles and the refining capacity to fill that gap is Beijing. Now I want to talk about the most extraordinary geopolitical reversal of this entire crisis, because it tells you everything about how desperate the financial situation has become. Reports have emerged that in an attempt to stabilize energy prices and relieve pressure on the US bond market, the Trump administration has been exploring the prospect of easing oil sanctions on Russia, essentially allowing Moscow to reclaim its market share in the global energy system, the same Russia that Washington has spent 3 years trying to financially isolate through maximum pressure sanctions. Let that sink in. The United States, fighting a war to contain Iranian power and reassert Western dominance over the global energy order, may be forced to hand Russia back its energy leverage in order to keep its own bond market from imploding. The empire is not just fighting Iran. It is fighting a two-front financial war against a world that has been quietly building alternatives to dollar-denominated energy for years. Russia has spent years developing payment infrastructure outside the SWIFT system. China has been building the petro-yuan. BRICS nations have been negotiating bilateral trade agreements in local currencies. The moment the US lifts Russian oil sanctions to manage its own inflation, it validates every argument that the petrodollar system is negotiable, that it can be bent by geopolitical circumstance. And once that perception takes hold, the structural foundation of dollar supremacy begins to erode. This is not a distant risk. This is the dynamic playing out in real time, right now. The financial toll of the Iran conflict is not measured only in interceptor missiles and drone counts. It is measured in the slow, grinding delegitimization of the institutions that have underwritten American economic power for 50 years. So let's be direct. Who is actually winning this conflict? Not Iran, at least not militarily. The US and Israel have destroyed significant Iranian missile launch infrastructure. The IRGC has absorbed substantial losses. Iran's capacity to rebuild will be costly and slow, but Iran's strategic goal was never to win a military victory. It was to impose an unsustainable financial cost. And by that measure, it is succeeding. The US is burning through interceptor stockpiles that will take years to replace. Its bond market is under pressure from energy-driven inflation. Its alliances in the Gulf are strained by supply shocks they did not budget for. Its domestic energy producers are benefiting from higher prices, yes, but American consumers are absorbing those same higher prices at the pump and the grocery store, and those consumers vote. China is emerging as the clearest strategic winner. It imports more than half its seaborne crude from the Gulf region. Short-term disruptions hurt. Costco has already suspended Hormuz bookings, but China has the refining capacity, the trade relationships, and the financial architecture to position itself as the indispensable energy intermediary for a post-Hormuz world. When BRICS nations need refined fuel, fertilizers, and industrial inputs, Beijing will be the phone number they call. And Russia sits in the most improbable position of all, sanctioned, isolated, written off, and now being quietly courted by Washington to re-enter the energy market so the US can manage its own inflation. Moscow has not fired a single missile in this conflict, and it may be on the verge of getting its market leverage back without any concession at all. The escalation escalator has an irony built into every floor. The higher the US climbs, the more it depends on the very adversaries it set out to contain. So what does all of this mean for you, the retail investor watching this channel? First, understand that energy-driven inflation is not transitory. The word transitory cost the Fed enormous credibility in 2021. If this conflict persists for weeks rather than days, the supply disruptions building right now will take months to unwind. The EIA is already forecasting Brent crude to average $79 per barrel for 2026, up from a prior forecast of $58. And that is the optimistic case. At current levels, closer to $94, the inflationary pressure is substantially higher. Second, watch the 10-year Treasury yield. If it climbs and holds above 4.5%, you are looking at a structurally higher rate environment for the rest of the year. That reprices everything: equities, real estate, corporate debt, consumer credit. Third, think carefully about gold and silver. When the bond market feels stress, when inflation expectations re-anchor higher, when confidence in the dollar's management erodes, hard assets tend to absorb that fear. We are in exactly that environment right now. Fourth, the geopolitical shift toward a multipolar energy order is accelerating. China's role as the world's swing refiner, Russia's potential return to energy markets, the fracturing of Gulf supply chains. These are not short-term noise. They are structural realignments that will outlast this particular conflict by years. The investor who positions for that transition, not the investor who waits for the all-clear, is the one who will be ahead of the trade. Iran's strategy was never to win on the battlefield. It was to hold out long enough for the costs to compound. The bond market is telling you right now, the compounding has begun. We are watching the financial architecture of American power come under sustained pressure for the first time in a generation, not from a military defeat, not from a diplomatic failure, but from the slow, grinding math of asymmetric warfare, where cheap drones drain expensive arsenals, where energy shocks poison bond markets, and where adversaries with patience and alternatives can simply wait. The empire is not collapsing overnight, but the structural costs of this war, in interceptor stockpiles, in treasury yields, in inflation expectations, in the credibility of dollar-anchored energy markets, are real, they are measurable, and they are building. If you are not paying attention to the 10-year yield, to gold, to what China is doing with its refining capacity, you are reading the wrong map. This is what changes. I'm May. Stay informed, stay positioned, and I'll see you in the next one.